Welcome to this Killik Explains finance video. This week, a topical topic in the context of Neil Woodford's woes, why investing stars eventually fade. Why is it that once star fund managers sometimes run into trouble? And Neil Woodford wouldn't be the first, and he won't be the last. So, the background to this is what? Well, star fund managers often eventually lose their edge. And I mean all sorts of fund managers. Hedge fund managers, for example, mainstream fund managers, investors of one sort or another. The latest would appear to be Neil Woodford, who recently suspended trading in his income fund. The future of that fund very uncertain right now. He's far from alone. So what goes wrong? I mean, what happens? Why does somebody who's turned in great performances over many years suddenly start to struggle? Now, there's no absolute scientific answer to this question. If there was, it would be a very short video. But I can put out 3 suggestions. So the culprits, what could be going wrong? A mixture of, one is hubris, getting a little bit too big for your boots, straying away from mandate. 2, a changing environment, okay? You haven't changed, but the world around you has. And thirdly, bad luck. And bad luck plays more of a role sometimes than people give it credit for. And at the end, I'll give you a book reference for those people who want to pick up number 3 in more detail. So, taking these in turn, very, very quickly. Hubris, what's this all about? Well, Dr. David Owen's written books on this stuff in the context of political leaders, but it's overconfidence. The problem with running an open-ended investment company of the type that was Woodford Equity Income is there's nothing to stop you growing as big as you want to. And boy, did that one grow big quickly, up to 10 billion AUM, around that at the peak, 2017. And basically the structure allows you to do that, even if you don't necessarily have 100% efficient use for the funds, okay? It's a structure that allows you to get as big as you like. Unlike a closed-ended structure, without going into too much detail, we could run a similar mandate, but on a finite pool of money. Isolation from criticism, all right? If the media keep telling you you're a star fund manager, your ratings on Morningstar are massive, everyone wants to talk to you, everyone wants to invite you in to talk, it can be the case that you surround yourself with advisors who never say no, who think everything you do is a fantastic idea. And if you've got a fairly dominant personality, that can lead to a situation where you are never wrong. And everybody is wrong sometimes. And an inability to see flaws in your own strategy can be the result. In other words, you convince yourself that what you are doing will come right in the long term. Bob Maxwell did this with his pension funds. No, it's all fine. It will come good in the long term, when actually, to an external observer, it's clear that you've wandered a fair distance from your original mandate, as it were. So, I could say a lot more, but hubris is a definite danger for those at the top. Then there's the environment. So, success breeds competition. The bottom line is, you may have been great for a period of time as a contrarian investor, betting against the crowd, not being suckered into technology stocks, for example, avoiding some of the pitfalls as we went through one financial crisis and then another. And Woodford certainly did that at his time in his previous stable, if you like, before he set off on his own. Size, unfortunately, does make marginal gains harder to achieve. So the problem becomes people start to look at you, scrutinise what you do, try and copy it. And that can lead to a temptation to move away from your original mandate. It's called style drift. It's where you're under pressure to keep delivering, because basically once you've delivered last year, people then take last year and add some to it and expect that. And the danger is you move away from your original mandate, which might be becoming a bit stale, a bit boring, a bit too heavily copied, a bit too easy to replicate with an index fund, for example, and into territory where actually you are not the expert and other people are. And illiquid securities of the sort backed by private equity venture capital can be dangerous ground indeed for a mainstream fund manager. And then there's bad luck. And this is underplayed as a potential culprit. And of course the reverse is good luck. So people sometimes underestimate the role of being in the right place at the right time with the right mandate on the upside and getting it all wrong on the downside. And of course, if you can mix hubris with a changing environment, style drift, plus bad luck, you've got a cocktail that can bring down the best of them. Now, this one is basically saying, well, contrarianism, which is the sort of mandate that a lot of very successful fund managers will initially go for. They'll say, well, when value's out of style, I'm going with value, and if they're proved right, they look like a kind of messiah, if you like, and the reverse is also true. It can result in outsized gains or losses. This is the point about contrarianism. People say, well, be greedy when others are fearful, fearful when others are greedy. And the point about that strategy is you'll either win or lose spectacularly in either direction. So we are wowed by Survivor Alpha. Woodford's reputation rested heavily on what he avoided as much as what he actually bought. So what do I mean by that? Quite a lot of his alpha was ducking some of the mistakes made by peers during the financial crisis, for example, as much as it was actively choosing stocks that might outperform the rest of the market. And the problem is that Survivor Alpha is not necessarily the same as stock picking expertise, or at least it blurs the boundary, if you like. So that's quite important. And if you move beyond your original mandate, then you need to be very, very careful to make sure you've got alpha at all. And we tend to forget about mean reversion and the laws of investing gravity. In other words, most investors will achieve roughly the average long-term return of the market over the long term. Some will outperform, quite a few will underperform, but the point being that inevitably the pack will catch up with a leader, and the returns of that personal fund will tend to head south. And the danger is that somebody who's watching their returns revert to the mean then starts taking risks to keep them above the mean. It's human nature. So for investors, what do we got from all of this? Well, basically, the best fund managers can outperform for many years. No two ways about it. Terry Smith, and Anthony Bolton before he went into China, and Neil Woodford. There's no doubt about it. So scrutinising fund managers, looking at their mandates, looking at how and where they generate alpha is definitely in the best interests of investors. But you must understand their skills, the mandate, the process, and look for examples of where somebody has, for example, moved away from what they were originally considered really good at doing. That's true in any industry, not just fund management. And when the facts change, be prepared to change your views. There are plenty of people wondering and worrying about whether, for example, Neil Woodford could pull off some of the spectacular returns of the past with what seemed like a rather different portfolio of investments to where he originally started. The harder I work, final point, the luckier I get, said Sam Goldwyn. But is that always actually true? And this is the point. Final couple of slides, if you like. Here's a basic, very simple matrix that plots luck against skill. Now, this is the point, is that, yes, a lot of fund managers put in a lot of work. That's a given. To be a top fund manager, you work hard, you know your knitting, you know your ropes. So you'd hope that that's a given in a lot of cases. All right? If you don't even believe a fund manager has skill and is not prepared to work hard, then why on earth would you hand over your money to them? But luck also plays a part. Now, clearly, you want, ideally, to be up there. But what I'm suggesting is it's very easy, if a good fund manager's luck suddenly changes, for them to suddenly sweep down to here, all right? And then if you're really up against it, you can end up over here. Because what you do is your luck changes and then you start to drift from where you were considered once to be the expert, and the amount of work you put in won't matter if you're up against people who've been doing it for a lot longer and have a lot greater knowledge of that part of the market. And to a degree, that may have happened in Woodford's case. So it's important, if you like, very, very simple Mickey Mouse grid, if you like, but to keep a watch on where you think someone is on that grid. To find out more, well, there's two options. That's Not a Bad Read, The Hidden Half, new book by Michael Blastland. And then there's the usual editor at Killik.com. And if you want to watch videos on funds in general, the structure of funds, then Killik.com/learn. And down this side, the funds tab.